good afternoon and welcome to today's The Dairy Signal. We're glad that you can join us on this Thursday afternoon. Today we're joined by Ben Buckner, Chief Grain and Dairy Analyst with Ag Resource Company. He will be providing us with a market update. As always, we encourage everyone to take advantage of having Ben with us live over the next hour and submit your questions. To ask a question, click the three dots in the bottom right corner of the video screen and select the Ask Question button. With that, I will hand it over to Ben.
Thank you, Amber. Always a pleasure to be here. And for the first dairy segment in a long time, I think we're going to talk about changes. And changes are afoot. I don't think that much will be impacted in the next 6 weeks, maybe 8 weeks, maybe 3 months. But there are things happening in the background. And to be very clear up top, I think that the risk in the US ag market over the next 12 months, maybe 24 months, is sort of a tightening or narrowing of those milk feed ratios. So that is the primary message we want you to take with you this afternoon. And so kind of go revisit balance sheets, think about feed coverage, milk production hedges. But I do think that all of a sudden, risk management is going to be a bigger deal and should play a bigger part at the farm in the next, second half of 2026 for sure. So this is all politics, politics, politics. This has been the case for a very long time, but I think starting up top, what is driving things and what is most important to us is one, this kind of US-Iran deal is still pretty elusive. The markets are kind of forced to trade sentiment in any given hour. And yesterday, we're thinking maybe we're on the final stages of some kind of peace accord, start the process of opening the Strait of Hormuz, getting fertilizer energy out of the Middle East. I think that sentiment's been somewhat reversed this morning, or at least it's show me the money now. How close are we to getting this done? But we're at a point where, like we talked about 2 weeks ago, the US energy balance sheet, and I don't think there's going to be rationing or anything in the US, but it's getting very tight very, very quickly. We have withdrawn 20 million barrels of crude oil from our strategic reserve to keep things balanced just in the last 3 weeks. And so if the strait's not opened in the next 30 days, 45 days, these trends are going to be difficult to sustain. We've been able to put a Band-Aid on the world energy market for now. The US is exporting a lot to markets that we haven't exported to before. We're withdrawing from our strategic reserves, but how long can that continue? The second thing, and I think the most important thing, is that we went home Friday night, markets looked pretty bearish, or rather, like we've highlighted, it is just completely normal for markets like corn, soybeans, and wheat to begin the path towards harvest lows from the early part of May. We thought that was forthcoming. We didn't get a deal from China. The May WASDE has come and gone. It wasn't very exciting. Only to kind of learn that I think we did, in fact, to get some kind of deal with China purchasing perhaps large amounts of US ag goods, grains especially, from 2026 to 2028. And we'll have to see confirmation of this. China's got to play their cards now, but the people that we've talked to that are higher up in the administration, and certainly we are, have said that most likely this is going to happen. And I think the core of the message is what China gets in terms of tariff relief is more than offsetting what US ag products they could buy, even if US ag products are more expensive. So again, kind of like 2020, this is going to be slow to develop. Confirmation. We're not really sure what's next for the markets, but we did want to communicate that thinking about the next 12, 18 months in the grain markets, it could look very different than it's looked the last 12 months. And so we haven't been able to say that for a long time, but those are the two driving things to us, the Strait of Hormuz and a probable deal with China. So energy costs, cost of production, especially producing grain, really everything in the ag space. That is, I think, what's in focus here. Again, we are monitoring sort of the pace of world fertilizer trade flows. There are restrictions in place in Russia and China. Those aren't exactly new, but I think that the Western Hemisphere will get their hands on fertilizer, but at what cost? Another 2 weeks has passed, and so we're thinking about what does the Brazilian farmer or the farmer in Argentina look at when they look at their own balance sheets? What is the break-even price of corn that makes sense for them to plant corn or wheat? And I think that's, plus or minus 5%, sort of where grain markets are going to go in the long term. It's going to be more or less the cost of production. We haven't solved any of this yet. And so make your bet. Do we get this solved this week, next week? Does it not get solved through summer? I think that the market's found fair value. Let's call it $105 crude oil. It will stay there until the risk is completely eliminated. And that only happens when the Strait of Hormuz is open. So it's either open or it's not. Today it is not. Vessel traffic is still very much restricted. And there's also talk about Oman and Iran getting together and charging some kind of permanent toll for movement in the Strait of Hormuz. So we are no closer today to getting some kind of deal, and we're unsure what Mideast vessel flows will look like 3 and 6 months from now. What is the cost of moving boats from the Mideast to everywhere on Earth? That's still very uncertain and probably won't be answerable for another couple of weeks. But I think mostly what is new this week and what we want to spend most of the time talking about is the fact sheet that was presented Sunday just after noon, and we are limited to 32 words. That was part of this longer fact sheet. And so we were thinking that, again, market seemed fairly simple. Weather is never perfect, but it's kind of hard for us to identify problems in the Northern Hemisphere. We got a very boring USDA report last week, and it's kind of the Strait of Hormuz was the last remaining risk. And, seemingly the trade team left China without getting much. And so we were beginning this process working towards harvest loads, but then we got these 32 words. So what jumped out to us was that, one, they highlighted again the agreement made in the Middle East last year. China will commit to buying 25 million tons of soybeans from the US per year, 2026, 2028. That was not unexpected. It's not even that unique to the markets or price discovery. It's a pretty good number. That means China does come back to the US soybean market more than they were in 2025. But prior to 2025, they were buying 26.5 to 28, 29 million tons of US soybeans. So kind of a boring deal, but it's the $17 billion per year of US ag products, 2026, 2028, prorated this year, in addition to that 25 million tons of soybean purchases or the pledge that China had made. And so what we're given with really is a riddle, if nothing else. I suppose that all we know is that China, if they don't want tariffs to resume on a lot of products, they'll have to spend $17 billion in addition to buying the 25 million tons of soybeans. So they could buy 35 million tons of soybeans, and a lot of this is satisfied. But if we kind of assume that they buy 25 million tons of soybeans, spend $17 billion on everything else, from lumber to tree nuts, almonds, fish, fruit, vegetables, corn, wheat, soybeans, sorghum, barley, and ethanol. And to us, it's really kind of hard to get to $17 billion, assuming this deal is confirmed and China chooses not to accept renewed tariffs and honors this deal. It does imply it's hard to work with precision exactly what China will do, but it's kind of hard for them, I think, to get to $17 billion without buying something like 300 million bushels of corn. So our take is that China is coming back to the US grain market for the first time in a couple of years. And this is what this looks like when we just operate under the assumption that it's 25 million tons of soybeans, which today's price would be about $11.5 billion, plus the $17 billion if they commit to this. You get to somewhere between 28, 29, $30 billion. And so this is what that looks like. It's not quite peak phase one agreement, but it's sort of the book-ended years of that peak one, phase one agreement. So it's a sizable amount that China will spend on US agriculture should they want to avoid the resumption of tariffs. And so again, we think this over the next 1-2 years is kind of a big deal. We're in the early stages of this. I suspect negotiators are still talking today, but they've created this kind of board of trade that acts as a clearinghouse. So you go to the board of trade and we can monitor what China is doing, what tariff rates are on both sides, and kind of work out what minimum quantities of corn, wheat, soybean, sorghum, again, tree nuts, dairy may be included in this. So there is, unlike phase one, there's kind of a structure to this. So it will be easier to enforce. And so, if they don't spend the money at the end of calendar year 2026, expect that the US will slap 10, 20, 30% tariffs on China if that's not the case. So again, the structure of this is a little different and a little more rigid. But it is the $17 billion that I think is most important. And again, the reason why that is because 25 million tons of soybeans, not new, not unique, not even really balance sheet or market changing compared to what we already knew. But this is, I think, what's new. Not often have they spent over really 12 or 14 billion dollars on goods outside of US soybeans. And so again, to get this blue line to be accurate, you've got to spend something like, $600 million on dairy, a couple $billion on sorghum, a couple $billion on corn. And so again, I think it's hard for us to operate under this framework without China buying somewhere between, we think it's 200 and up to 500 million bushels of US corn at some point in the next 12 months. And again, that's all brand new. So if we think about feed costs, corn specifically, and there's a lot going on. Again, the cost of production that everyone is facing, but we're most concerned about South America. They start planting again August, September, and October. Price of energy, weather, and now this. So kind of every part of the balance sheet for corn is a blank canvas, but provides some kind of boundary to where we think the market goes and what supply and demand is. We just start going through scenarios. And again, we think that balance sheets still determine the season average cash price of any agricultural commodity. Unfortunately, none of this will be exactly correct, but just wanted to show you what we think and what has changed in the last really 4 days when we think about US corn supply and demand over the next couple of years. So we're kind of locked into 94.5, 95, maybe as low as 93.5 million acres. And the assumption there is just costs of production were really high. It's been kind of cool, wet. If there were any switches, it made economic sense to plant soybeans, the northern US over corn. We're assuming yield, weather adjusted trend, 183 bushels an acre. But what's I think new is we've got to now look at the risk that there will be no contraction in US export disappearance for corn because of this deal that's been made with China. So Sunday morning, this balance sheet had US corn exports next year as low as 2.8 or 2.9 billion bushels. And the reason is fairly simple. Just an incredible amount of corn is being produced in South America this year, to the point where it has rained across the Brazilian winter corn belt as late as last weekend, which is kind of abnormally late. So that crop is getting bigger, it's not getting smaller. They're going to have a little bit more corn to export the next 12 months than they did the last 12 months. Argentina's crop still looks very, very special. All-time record by 10 million tons, we think. And that's what actual yield data through the middle part of May is pointing to. So there's going to be this reshuffling. We were serving markets like West Africa, big markets in East Asia. Those consumers will buy cheaper corn from Argentina and Brazil now. But it's very difficult for us to lower US corn exports below something like 3.2 or 3.3 billion bushels. So what's left at the end of the year is no longer something like 2.2 up to 2.5 billion bushels, but instead it's 1.7, 1.8. And that assumes something like normal Midwest weather. This by itself is not very exciting. And I think even the readjustments that a lot of people are doing to US corn balance sheets in the market this week hasn't meant a whole lot. You can see the market's probably going to close unchanged on the week. That makes perfect sense. But unlike balance sheets presented on Sunday morning, there is not a lot of tolerance for either, let's say, a surprisingly high feed and residual number for old crop, at which point you've got to lower carryover stocks, 50, 100 million bushels from where they exist today, or yield. And so all of a sudden, I think the market's going to be very, very sensitive to yield during the summer months, even if there's no real confirmation or China isn't physically buying US corn yet. And it may take them 12, 15 weeks before we see any kind of hint that this thing's moving along. But a U.S. corn yield, or the perception of U.S. yield below 180 bushels an acre. I don't know. We don't have that crystal ball, but all of a sudden the perception of in stocks drops to like 1.4 or 1.5 billion bushels. And that is a more exciting market. Then you're talking about the need for acreage expansion, more corn in South America, maybe rationing the domestic market to some extent. And so that is a scenario. Another scenario is that yields 187 bushels an acre, at which point we've got 2 billion bushels again. So we're kind of back to where we started to some extent, in that it's always weather after May 15th. But unlike expectations before this weekend, I think kind of every week's forecast and crop condition is going to gather a lot more attention than we thought it would just a couple of days ago. And so I think if you think about the U.S. or the global feed market, the global grain market, it's kind of this accordion that expands and contracts. I think the idea is that for the next 12 months it will be contracting, not expanding, especially in the United States. Maybe the U.S. will be this kind of island of rapid supply and demand tightening, but that's what matters to us as dairy operators in North America. So this is just, I think, a risk that we want to be pretty clear in presenting when we think about corn, not for the next 30 days, but for the next 8 or 12 months. And again, if we don't have ideal weather, drought in Nebraska, Kansas today, yields 182. The market just looks, supply and demand, the balance sheet looks a lot different than it has the last, 14 months. And assuming that corn stocks to use will not be 15%, but closer to 10, 11, maybe 12%, you are probably raising season average cash price fundamentals to something like 450 or 470 per bushel. This model, again, assuming our balance sheet is exactly correct, would kind of spit out something like 460 or 465. USDA's 440, absolutely in the ballpark. Last year's price would be 420. So again, corn market moving up, not moving down. So the question that we've got is, where does this red dot, is it moving to the left or to the right, or the perception as we get into the growing season? So you can kind of see if you cross this threshold, we'll call it 8.5 or 9%, you are in a market that people are concerned, and the game of musical chairs starts to kick in, and we've got the potential for season average cash prices of between $5 and $6. So this is all based on Mother Nature's performance, but I think there is a heavier burden placed on weather from June to the very end of August, and what do we get from Mother Nature? I think soybeans, so far, given what's happened with the U.S.-Chinese agreements or proposal for agreement, we can't really change much in the balance sheet. So the soybean fundamentals are kind of the same as they were a couple of weeks ago, far less exciting. But already before anything happened with this proposed $17 billion of spending by China, we knew the soybean market too would be very, very sensitive to weather. And I think weather, like in the last 2 years, the Midwest does turn hot and dry in August or not, is going to be pretty critical to where the market exists at harvest. So we, like the USDA, will assume 53 bushels an acre. We're kind of adding to planted area because of cost of production, some regional challenges with corn seedings. We're kind of left with steady building stocks. But if the perceived yield's 52 or 51.5, we've got kind of a problem in the soybean market, because we are going to maximize crush. That will be 2.75 billion bushels. I think that is more or less locked in. Exports do expand because of China, but Brazil will take more of our market share to places like, I think, even Mexico, West Africa, etc. The soybean market isn't overly loose, but like corn, weather is going to matter an incredible amount. And this was kind of unexpected, at least 90 days ago. We thought we'd be swimming in soybeans, and that has turned out not to be the case. And China's commitment to buy 25 million tons per year does keep exports above 1.6 billion bushels. So can we yield our way to loose balance sheets is going to be a very, very big question. And I think we'll get, it's not relevant, but very early season crop condition ratings in 2 weeks. So then I think the game is on. What does that mean for yields? We know that the correlation between crop ratings and USDA yield projections gets stronger and stronger as the summer progresses. We also think that kind of suddenly the Midwest Mid-South wheat market has joined corn and the hard red market in not having an abundance of supply. And this is, I think, all because of the potential for Chinese demand. Now, what is different for even soft red wheat compared to corn is soft red wheat is not at all competitive in the global market today. If you think about corn, Argentine corn is the world's low cost origin, but it's only by about 30, 40 cents per bushel. Soft red wheat out of the US Gulf is $1 per bushel higher than comparable French origin. So, there's not a lot of incentive for the private market in China to source soft red wheat. But again, this is all about politics. And it doesn't really take much. So, for risk management purposes, we are kind of assuming that soft red exports will be something like 100 and 125 million bushels. And if China were to secure just, I don't know, 10, 12 million bushels, that kind of becomes a big deal given we haven't seen evidence to support real yield growth in soft red. It will be a very high yield, but not a record. And abandonment is projected a little bit higher because I think of spotty regional freeze damage in places like Kentucky and the southern Midwest. So the soft red balance sheet, assuming really no change in total disappearance, does get historically very tight. And so you're kind of left with this grain market because of these 32 words that were given to us by the White House, where you can't lose a lot of total cropped area in 2027. There's suddenly a heavier burden placed upon weather patterns in Europe, the Black Sea, China, when we think about wheat, corn, and oilseed production. And does there evolve something like a battle for acres winter, spring 2027? And again, it's just this press release from the White House that did, I think, fundamentally change the structure of risk in grain markets when we think about the next year. There's a lot more going on as well. So we think about two wars, high cost of production, near record crude values, some kind of deal established with China, and also what is somewhat unique to this week is the European Union and Argentina are still battling over GMO soybeans and soybean meal. So a couple of weeks ago, a cargo of Argentine meal shipped to the Netherlands was found to have the gene HB4 in it. It's a drought-tolerant gene, and just one that's on the list of European Union's kind of unacceptable genes to have present in food. So they've rejected Argentine cargoes, and we thought that this might be able to get sorted out. Argentina can test at origin, confirm it doesn't exist in this cargo of soybean meal, and bada bing, we're back to normal trade flows. Europe buys a lot of soybean meal from South America specifically. But as of this dairy signal, at least, the issue has not been resolved. And so, Europe imports pretty routinely 25 or 30 million tons of soybean meal. And the way it stands now, private buyers are not going to buy soybean meal from Argentina until this is resolved. So I think there's a lot of potential for the US soybean meal market to fill this gap, at least until it is resolved. So there are really no issues in making what is a record amount of soybean meal being produced in the US. Just incredible. Every month, production's up, 10, 12, or 15%. There's tons of supply, but we're having no problem with demand absorbing that production growth. And this is part of the reason is we're going to be shipping a lot of soybean meal to Europe. So there is this competition between, feed markets, kind of a growing poultry market, unchained hog market. Now we've got European demand for soybean meal. So it's kind of difficult for us for now to be overly bearish with soybean meal relative to current prices, which are not terribly expensive, but we don't think that market can sustain breaks until this gets resolved, this issue between Europe and Argentina. And so if we think from a very high level, everything that's going on, wars, fertilizer, deal with China, fewer corn seedings, droughts in the US plains. And I think it's safe to say that, last year's harvest lows, in corn and wheat at least, probably multiple year bottoms. Now, the degree of recovery and the shape of this uptrend line will, want to be clear, totally dependent on Mother Nature. The addition of premium will be slow and kind of measured if we do avoid weather problems. But we do think that on balance, corn wheat prices, cash prices on a monthly basis, higher lows, higher highs 12 months from now. I think that's sort of the default position that we're thinking about when we think about the long-term direction of grain markets. The other side of this, though, is this does just complicate things. And so I think the reason that you've had these kind of new slow building plateaus in feed costs have all been because of one, several rounds of US-Chinese negotiations that started last summer. We got China to buy 12 million tons of soybeans. Then we were uncertain about them buying old crop. And I don't think that they will buy more old crop. But now we've got this 25 million ton deal in the works. Now we've got the $17 billion pledge from China to buy non-soybean goods. And we've got war in Iran. So we're kind of thinking about the US for the next couple of years at least being managed trade. And so it's not inherent growth in the demand for US products because, and this is not new to the last 10 years, but we are the high cost producer of a lot of things. But we've been able to kind of piecemeal deals with China, the world's largest consumer of grain and soybeans, from an import basis, every 4 to 6 years. And so we get these spikes. So what's the other side of this look like when Brazil, South America, the Black Sea will find all of these other markets? So again, just wanted to kind of highlight that this is not organic demand for U.S. goods, but rather it's just policy-based, and it's really just between the U.S. and China. So that does complicate kind of the 5-year outlook. What do exports look like in 2029? Does Brazil continue to grow soybean production, corn production? And we've become very expensive in the U.S. because we've got these managed deals with China. And the other side of this, again, I don't want to rush to say it's straight up markets are going to digest tightened balance sheets immediately. I think this is going to be evolving over the next 6 months, maybe the remainder of calendar year 2026. For now, there is no shortage of stuff on Earth. And I think that's what's different, meaningfully different than something like 2021 or 2022. So we can kind of back into, and this will be fine-tuned in upcoming dairy signals, but we can kind of see how much corn was made to disappear between March and the end of May, and kind of work into what corn stocks are on June 1st. And we do think that that's still going to be up 800 million bushels on last year, right? An all-time record, 5.4 billion bushels. Like we kind of talked about earlier, South American corn production will be the highest it's ever been. Export potential will be the highest it's ever been. Mexico, which has been an incredible growth market for U.S. corn, probably at least has the ability to, if this China demand does come to fruition, source fairly reasonably priced Argentine corn. There's no shortage of supplies or alternatives available to importers, at least for this calendar year, if China was to come in and buy a bunch of U.S. goods. South American corn prices not really reacting to either war or this deal with China. We're seeing Brazilian cash corn prices move lower as they always do in late spring. And even the Brazilian ethanol market starting to collapse. Maybe they're starting to produce too much of that. So shuffling trade flows is kind of the name of the game once this Chinese pledge comes to fruition at some point in the remainder of 2026. We also, for now, and I think this explains market activity this week, is there's still, I think this has been shown, a decent amount of war risk premium, which makes sense. Again, corn has to be more or less the cost of production globally. Cost of production is higher because of energy, fertilizer issues. If that were to be unwound, if we do successfully get some kind of peace accord, I do think the cash ethanol market will drop 20 or 25 cents a gallon. Where corn sits today, that does sour margins pretty substantially. I think to the point where you calculate Western Midwest, revenue is probably below variable cost. And so at that point, you're probably seeing a slowdown in domestic corn use. So there's a lot of moving parts to this. And the two dominant fundamentals, I think for the next couple of weeks will be war in Iran. And does China do anything? Do they confirm that they've dropped the current 10% tariff on U.S. grain and soybeans? Does Iran start to allow vessels to move more freely up the Strait of Hormuz? Those will be, I think, still more important than weather patterns for at least the next couple of weeks. But then we throw in What becomes, I think, the most dominant fundamental, which is also unknowable, and that's going to be sort of northern hemisphere weather patterns. So it's very interesting. I cannot sit here today and say that things have been completely perfect or smooth in a lot of the central US. And I think we will all have to contend with drought west of the Rocky Mountains throughout summer 2026, which will have an impact on cattle prices, which we'll kind of touch on in a bit. It's going to rain too much in the next 5 days in places like Louisiana and Arkansas, Mississippi, West Tennessee. And I think the concern here is that, at least for now, talking to clients, some of these fields have been planted in the last 10 days, and those fields are just not going to see any sun for the next 2 weeks. So we're kind of delaying crop cycles. We thought it'd be very quick and we'd get a ton of corn in the first half of August, and maybe that's being changed by this weather pattern. For now, though, NOAA's not even really projecting any flood risk in Louisiana and Texas, just kind of excessive rainfall. But also the other side of this is that drought should be eased considerably or maybe eliminated in the Southeast. So you start the growing season, we've got a lot being thrown at us: fertilizer, war in Iran, possible demand from China, in the next 90, 100 days, but also kind of an absence of drought in the central US come June 15th. And that is important. I think that we still have to use balance sheets, measure supply and demand. And so can we yield our way out of this above and beyond what China may buy? That's going to be a fundamental that's thrown into the mix beyond the next 30 days as well. And I think too, thinking about this is, putting it all together, I think the market's going to struggle to sustain big moves in either direction. And on the bear side, I think the argument is that we've got a lot of stuff today. There's a lot of stuff on Earth. Weather outside the really western plains in the northern hemisphere looks pretty good almost everywhere. And El Nino. So we will reassess the impact of super El Nino probably in the early part of winter. For now, it's, I think, going to be kind of a normally evolving El Nino climate. And you go back many, many decades, and that generally implies mild, wet, central US weather. The best possible odds that corn, soybeans, and spring wheat yields will be above trend. And that's what a lot of the climate community is giving us, at least as of this week. And these have been fairly consistent. And I don't think there's a whole lot of secret or much behind the curtain here. Drought tends to beget more drought, and this goes globally, where it's adequate to surplus soil moisture, and maybe we deal with too much rain, but that does tend to foreshadow an absence of heat and dryness, 90 days later. So Climate Impact Company is a forecasting service we work pretty closely with, and this is their latest this week summer climate forecast. So the PNW, very hot. Texas, Louisiana, very hot, possibly very dry, but otherwise everything looks pretty normal. Adequate rainfall, normal-ish temps, and the details of this forecast, which we caution against putting a lot of confidence in the precision of 90-day outlooks, but August, and I think this is correlated to El Nino, August looks a lot better than it has the last 2 years. So kind of mild, wet weather in August. And also, again, I don't think that this is going to be perfectly correlated to what normally happens when El Nino is present. But so you have this kind of cool-ish, wet Midwest pattern. And then when autumn kicks in, it gets very warm and very dry. So that is, I think, why when you look at years when El Nino is present, you have really good yield performance, is because, as crops maybe slow to, accumulate growing degree days, you still have September and October where it's abnormally warm and pretty dry. The U.S. Weather Service just this morning gave us their temperature and rainfall probability outlooks for the summer season, and they look kind of similar. So you do have better than zero odds of net moisture loss in the upper Midwest and Dakotas, but for the most part, this is a pretty normal outlook for summer in central US in 2026. So again, as you can, for now, start to adjust balance sheets to include higher corn demand, sustained wheat demand, growth in US soybean exports, we still also may have very, very large crop sizes come September 15th, October 1st. So it's going to be a very fluid, dynamic, we think, a very volatile summer in the ag space. And for now, I think it's kind of, as things have changed pretty rapidly, you still can develop, I think, a pretty good strategy. So you know what to do with bushels if you're producing corn, soybeans, or spring wheat that you want to sell off the combine. I don't think we're going to avoid some kind of seasonal price weakness. So we can go back, almost 20 years in corn, and you can see that the only 2 years where the market's really added premium during the summer months has been 2010, which we've talked about before, ultimately a Russian export outright ban, and 2012, which was the worst drought in many decades. Otherwise, I think the market just kind of preps for harvest. And to explain these seasonal trends, which I'm sure we've all seen lots of graphics, price charts that relate to seasonal trends, to me, it's just you can't change the fact that in production agriculture, each hemisphere gets all of their supplies all at once. We can only hold so much. So the value of corn, physical bushels of corn on October 15th is just not going to be nearly as high as it is on April 15th. And this goes for markets globally. And so I don't think we can avoid this. Thinking about even 2021, 2022, those years have been highlighted because they're still in the throes of the phase one agreement and an absence of global yield productivity growth. We still dropped corn up to $1 per bushel from the end of May to the end of August in those years. Again, I think it's because you really can't hold long positions once you get many, many billions of corn bushels available in the physical cash pipeline during the autumn months. So again, it's not, I think, a wise bet to make that straight up from here. I think we've got to contend with pretty good weather forecast, large supply availability currently. But here's, I think, the issue that we're kind of getting to is that these income over feed cost forecasts are being trimmed. These ratios probably get smaller. They don't get wider. And that's the risk management we want to think about from the dairy side of things. And I think it's kind of twofold. One, we're learning that there's been a real absence of total growth in dairy product disappearance. And as the futures market has shed some kind of premium, our cash price forecasts, which are not bad, have been lowered to 19, 20, maybe $20 and a half when we think about all milk cash prices from now until the month of October. And so I think that we're kind of back to where we were maybe a couple of months ago, and that locking in margins makes a lot of sense. Using recoveries in class 3 to hedge forward production, as always, we highlight Q1 of 2027. And just kind of wanted to lock in these milk feed ratios where they sit currently, because unlike the evolving supply and demand scenarios for corn, milk doesn't participate as much. And I think that's because, again, talking to people close to negotiations, China will probably match the purchases that they've done last couple of years in U.S. dairy, but I don't think there's a lot of room for growth. And the core reason for that is just whey is very expensive. And our domestic market is going to absorb all the whey that's available because protein demand is just through the roof. The second part of this is U.S. consumer sentiment and consumer balance sheets. So we highlighted this, I think, at the beginning of the year, where the U.S. stock market doing pretty great. But it's pretty clear that it's completely a function of the build-out CapEx spending in the AI sector. When you get into other industries, construction, housing, retail, it's not doing nearly as well. We're seeing real wage growth contraction. And this is just the latest published by the US government, Michigan Consumer Sentiment. So in fact, they don't publish the latest reports in case there are revisions, but as of April, it was the lowest on record. 49.8 was the Consumer Sentiment Index. So I think it's kind of reflective of kind of what's happening from the food demand side of things. We're seeing almost half of restaurants during the winter months report, lower traffic year over year. Same store sales getting more evenly matched between better or worse than last year. SNAP program so far has lost 4 million people in enrollment. And so this just doesn't bode well for actual food disappearance. And I think that's why the dairy market's been doing what it's doing. As we think about war in Iran, fertilizer costs are an issue for corn, but I think it's consumer spending on food that's an issue for dairy, and it doesn't bode favorably for, I think, restaurant traffic growth through the rest of the year. And otherwise, it's kind of more of the same. We do this every 2 weeks, every 30 days. Just no sign that production is contracting in New Zealand, Australia, the US, of course, Argentina, or Europe. So this week, we've only got April production data so far from New Zealand, and it was up for a 12th consecutive month, 1.5 million tons, or about 3.5 billion pounds, up 6% on last year. We've seen the last couple of weeks, previous European milk production revised higher, not lower. And if we go through at least the end of March, this is what that looks like. And so we've kind of, to keep things very simple without getting into the weeds or precise price forecasts, if these bars are above zero, you're probably not in a bullish milk market. And if they are below zero, you probably are in a bullish milk market. These are still very much above zero, and I don't think that changes at least for the next quarter or so. And with respect to China, I think part of the reaction or lack of reaction in the dairy space so far is that we never really had any kind of adjustment to U.S. dairy flows to China, except for April and May of last year, peak tariff battle. Otherwise, China's been a pretty normal, regular customer of U.S. dairy, so the $17 billion probably doesn't entice China to do anything different. I do think they're going to spend $600 million on U.S. dairy, which is not a record. It would be a 2-year high, but not remarkably so. So China will be a large customer, but we're not going to see the growth in shipments to China like we're seeing in corn and potentially wheat, and certainly not soybeans. The other side of this, and this bodes, I think, pretty positively to dairy operation revenue, but also U.S. cow numbers, is the beef market still a long way from seeing any kind of expansion, specifically in cattle numbers. Maybe we have to contend with herd liquidation depending on how drought evolves west of the Rockies. But in terms of structural expansion of cows and beef production over the next couple of years, I don't think there's any sign of this happening. I don't think China is going to buy U.S. beef, but that was part of the negotiations, was China allowing for the sale of U.S. beef, which, if happens, only exacerbates this. Mandates a quicker return to herd expansion, beef production expansion. And so all of that, I think, leans neutral to bullish cattle prices from where they sit today. So that beef dairy crosses still going to be excellent revenue, but that's also going to keep the dairy herd, I think, pretty robustly supplied. So we are thinking about U.S. milk supply availability the next couple of months. We're kind of assuming that, unlike last year, kind of normal trends hold in the evolution of cow numbers. Still a very large 9.6 million head forecast at the end of May. And we've got peak production in the U.S. Northern Hemisphere kind of staring at us in the face. So barring major changes to per cow output numbers, we think production in May is going to be up 1.5%. About 20.5 billion pounds, which will be a new all-time record for any month, and just above production in March. Slow, normal downgrade thereafter, but I think just the flow of milk, product supply availability, there will be no shortage of stuff during the summer of 2026. And now I wanted to kind of tell the story, I think, the other side of this, and where I think we're more intensely recommending thinking about the forward markets, winter, spring 2027 production, hedging on recoveries, locking in feed margins, et cetera, is because we kind of go through this. What is the state of total U.S. dairy consumption in the first quarter of the calendar year? What kind of jumped out to us is, when we highlighted this 2 weeks ago, just incredible exports. The U.S. in the month of March ships 266,000 tons of all dairy products, 8% higher than last year, which was up 8% on the previous year, just making lots of the stuff disappear. Competitive prices, attracting demand. Cheese exports, 64,000 tons, just an unheard of number. Production also, growth unremarkable to non-existent. Butter production in the month of March, officially 232 million pounds. We'll call that unchanged from last year. So we're no longer seeing growth of 5%, 8%, 10%. U.S. American cheese production was 488 million pounds, down 12 million from last year. So it was kind of surprising then to put these numbers together and seeing inventories build. Now, this is all seasonal in nature, but the sort of speed at which butter stocks are growing, the discrepancy is narrowing this year to last year. And we probably ultimately on May 31st get to 350 or 360 million pounds of butter in cold storage. And that's when butter supplies peak. Butter supplies peak in May, but we're kind of on our way to that point. Butter supplies will be very large in May, June, and probably July. But they're building month over month and by a faster rate. Cheese stocks, 802 million pounds. That was up about 10 million pounds from the previous month, but we had no production growth. We had incredible export disappearance. So when we get the USDA's monthly dairy product output report, it's one of the most exciting for us because we can back into total demand. And those numbers were not exciting. So technically, total butter disappearance was down fractionally from last year at 222 million pounds. American cheese disappearance down 6 million pounds from last year at 482 million. So we kind of worked again back into domestic use for cheese. I think it's probably down 10 or 11 million pounds from last year. So we're not finding demand growth. We're producing lots of stuff. So is Europe. So is New Zealand. So is Argentina. Restaurant traffic, consumer sentiment may be more difficult moving forward to tighten dairy product balance sheets. And that is, I think, our chief concern when we think about the details of US dairy supply and demand. Now, the pillars, though, of I think still $20 all milk cash prices, $19 plus all milk cash prices through the end of calendar year 2026 is this insatiable demand for whey protein. The powder market is more difficult to explain because we are building stocks, we're producing a lot of stuff. Still, the market's doing what it's doing. It's more than doubled from last year. The latest we've got, this is non-fat dry, central region, $2.38 per pound. So when you're calculating all milk cash, that still leaves you with something like $20 a hundredweight. But the risk, I think, is thinking about these other markets, thinking about feed costs, thinking about ongoing production growth, on Earth, probably for the foreseeable future. So from a very high level, we think over the next year, feed costs will be going up, fuel costs, uncertain, probably slow to go down, and the milk market, the risk when we start to think about winter, spring 2027, probably lower milk prices. So we want to start thinking about risk management. And if we've got margins, I don't think you can go wrong by locking those in. So that is the spiel for today. There's even more things driving prices than there were 2 weeks ago, 6 weeks ago, but we're here to help you navigate it. If you have any questions or complaints, here is my email address. Please don't hesitate to reach out at any point.
Alrighty, well, thank you, Ben. You covered a lot of information today. So what are a couple key messages that you want our viewers to take home with them?
I think one is that when we think about the feed space, odds are growing that we will in the US, maybe not everywhere else or anywhere else, but demand growth is back because of China. That tends to raise the value of those things. That is not insightful, but I think that is a risk over the next 12 months. Second thing is, I think we're starting to see real impacts of kind of non-AI based sectors contracting. And that, I think, is a concern to us when we think about restaurant spending, total food demand. So things are changing and margins, there is risk in the dairy space.
Okay. Well, thank you, Ben. And we want to thank everybody at Ag Resource Company for actually, hold on. We have a question that just came in for you, Ben. It says here, with the likelihood of great production, we are on the edge of a challenging time if we depend on exports, right? Is how the question is stated.
I think so. That's something else that has been very slow to evolve. And I don't think the export market loses excitement in the dairy space for a couple of months. But European cheese, for the first time in a couple of years, is the same price as US cheese. New Zealand is exporting a record amount of butter. So again, and we'll do this every 2 weeks, but as long as those production bars outside the US are above zero, it's going to be more of a slog to sustain our share of world trade. I think we can do it, but most importantly, that's done through price. So that I think to me, exports will be very good, but we've got to now compete for those markets that we're serving. So I think the answer to the question is, yeah, I think the export space over the next several months will be more difficult just because there's a lot of stuff outside the US.
Okay. Alrighty. Well, that is it for questions. So again, I want to thank Ben and everybody at Ag Resource Company for their continued support of the Dairy Signal. And I hope everybody has a wonderful Memorial Day weekend, and we'll see you here next Tuesday.